conjunction with Biz Talk Today TV and CrossCheck Media, this is Buy, Hold, Sell, and I am your trader, Todd Schoenberger, joined by my friend and co-host, Tobin Smith, out in Scottsdale, Arizona. Toby, stocks are flopping, bonds are popping. What do you think? Bond yields are popping. Is this the standard, or what should we think going forward?
Who are you?
Yeah, that's what I'm going to say, because let me tell you, I want to tell you who has all the answers is our guest, our featured guest today, Erin Gibbs. She is the CIO over at Main Street Asset Management in New York City. And Toby, I know you don't have all the answers, but I think Erin might have some answers. So I'm just going to go right to her right with this.
Oh, that's hurtful. You've hurt me twice here already.
You have the 10-year yield, Erin, at 4.6%. Actually, just slightly over that. Stocks obviously are falling. We're coming up to that dangerous territory level, close to that 5% that stock traders do not want to see. What do you think, though? Is this just a short-term blip, or should we be thinking about selling for the rest of the summer?
I don't know if we necessarily have to sell, but I think you better be ready for some volatility as long as we have these conflicting inflationary notes. And so part of this is a continuation of some of the hawkish comments that we got from one of the Federal Reserve representatives, as well as the beige book came out today. It wasn't a resounding, oh, inflation's down, we're definitely going to see cuts. It was again this constant mix and continued uncertainty of, are we going to get cuts or we're not going to cut? Is inflation really going away or not? I personally think when you're looking at the PPI and particularly also natural gas prices, that we're not going to see inflation going away, and that the idea that people think that cuts are going to happen this year is just not terribly realistic. I actually don't think it's going to happen.
Yeah, I'm totally with you. I keep seeing these guys. I did the show this morning. It's like, okay, yeah, we're going to get 3 cuts this year. Yeah. Really?
Yeah.
I mean, honestly, Erin, and I've talked about how long I've been doing this. These guys and women are using models that are based on 1960s, 70s, and 80s models that have nothing to do with the post-pandemic dual war, China-America war. Next thing you know, we're going to have war in Canada, for crying out loud. And it's so good. All right. And then, oh, by the way, the Panama Canal, worked really well in the 60s, 70s, and 80s, and now it's down 35 feet, and ships can't get through. They have to go around. I mean, there is almost nothing. Oh, by the way, the United States is the largest exporter of oil, which never was close in the 60s, 70s, and 80s when you guys were not even born. So I just, it befuddles me. I love how they had the article in the Journal this week about how the last 2 remaining bears, Kalanovic, he was so right for so long. What did he change in his model? I mean, I would call him and talk to him, and he was just dead right in 2010 to 2000. But man, these guys, and Mike Wilson, I mean, God bless, great guy. Really helped in a lot of ways, but man, when the freaking information changes, it's got to, your outlook has to change too. You can't just go back to the same playbook. Okay, I'm done.
Now I get it. You're absolutely right. But Erin, I mean, you have so many, the FOMO trade. A lot of people are getting into the markets now. You had that article that came out today in the Wall Street Journal, how Gen Zers are now in a race against time, just trying to catch up. And now they're pumping in all this money into their 401ks and IRAs and everything else that they can do. There's all kinds of cash. And then all of a sudden, it seems that the suckers are getting in and the professionals are getting out. But as you know, these types of trends they're not short term. They tend to go on for a while. And especially when you start seeing yields creep higher, it is a warning sign. I mean, I guess right now, what would you be buying right now, or what are you telling your clients to start focusing on?
So I've been looking at if we do have inflation, and there are a lot of signs. And there, obviously, everybody loves this AI trade, and I think NVIDIA is a little long on the tooth, so there's certainly room for it to keep going. But aside from NVIDIA, I think some of your easier plays are actually out of energy, because that's one thing that has been a little overlooked. It's in order to run all of these servers, you need electric. And so we've seen the energy sector move. We've seen utilities really take off. That's where a lot of some of the market has been going up. But I think looking to natural gas companies is actually a really easy play for the next 6 months and can continue on that trend and really good, strong fundamentals. And I'm focusing more on small and mid caps, even though I don't believe we're going to have a rate cut. I think that the value that you get within the small and mids is just so attractive that I'm okay, let's say, underperforming for the next 6 months and then massively outperforming in 2025 when the inflation question starts to die down. And
have
so,
you told that to
in,
your have you told that to your clients? Because really, if I ever told my investment clients, by the way, I'm very happy to underperform for the next 6 months, they would say, "Adios, mi amigo."
Now, look, I'm okay with, let's say, first of all, these companies are like, you're getting in at like 6.5 times forward earnings. They are so cheap. At the very least, they're not gonna go down. But I do believe, and this is one thing I learned very early on in my career at Bernstein, is if you're a value investor, it's okay to get in a little earlier. It's much harder to time that absolute bottom or that absolute, point of underperformance. And I think that this is coming. I'm really convinced that this is absolutely going to come, whether it's in 6 months or 3 months, that shift. And we've already started to see a little bit of shift of the small and mid starting to catch up. So just looking at the valuations, the S&P 500, it's still very concentrated. It's still highly overvalued compared to interest rates. I don't see cuts being so dramatic or, like I said, happening this year or having huge cuts going into 2025. And so I think this, higher for longer is very much a valid story. But I also like the idea of getting something on sale. Like, I like getting stocks on the cheap. And these natural gas companies and these energy companies, particularly in the small and mid cap space, Dorian LPG is one of my absolute favorites. They've been doing phenomenally well, and really bucking that trend.
Hey, I'm a growth investor and I own LPG. I happen to own B Willie, now BWLP, because LPG rates. I mean, I am an inflection investor. Erin, that's what I do. Transformative research. That's what I do. I hate value. I see value and I just puke on it because I don't see the catalyst. And in my career, my favorite line always would be, "But things are so cheap," and maybe there's a reason why they are cheap. Number one, and then number two, again, I'm looking at this buy list here of our actual NVIDIA Supermicro, AMD, Pure Storage, Vertiv, which is in a paper today, which is why we're going to have to sell it because now finally it gets in the Wall Street Journal. I mean, we're up 145% in a portfolio of 20 stocks. That's 14 years of wealth. I am telling people that you're a freaking idiot if you don't or I don't take some of those profits now and build cash, and to look at at things that you're like, for instance, Eaton. We've been buying Eaton because, my gosh, they do as much cooling in the hypercenters as Vertiv does. Supermicro, no, at 48 times forward earnings at this point. It was great when we bought it at $25. We bought it at $136. Geez, Vertiv was great at $25. It's now $110.
Yeah.
And we did most of this in April or May of last year, so there's capital gains now. So I am warning my clients that I'm going to force you to take 14 years of some profits that you earned in 12 months. Don't be greedy. Build some cash, because at some point in time here, it was just like a marathon, man. And somebody ran it at like 100-yard dash, and it runs out of gas. There's nobody left. And Todd, I think you make a great point. The amount of cash coming into ETFs and S&P and QQQs and is absolutely sustainable. But they're buying all the same damn stocks because they're all market cap weighted. So that's when I go back to Kalanovic, who's saying it's the market cap weighting of indexes that has screwed everything up. I don't know. How do you feel, Erin?
I have nothing against market cap weighting of index. I think that's really one of the interesting ways of being able to outperform the indices is, if you understand what you have to beat, it just makes it easier to do. So I don't believe in equal weighting when it comes to, equal weighted indices. They're not representative of what the market is, like where people have put their money. But indices aside, I mean, you can easily do, you buy an ETF that's equal weighted. There's lots of those as well. But at least, you have to understand just the bias when it comes to smaller price stocks and the relative returns of those companies.
But let's also not forget that this is like 1995, 1996. This is a brand new AI industrial revolution. Yeah, it's been hyped, but we're literally in the first inning. I again, old enough to remember when we started doing AI in like 1989, 90. Well, it was not AI, it was just machine learning. But when the application layer gets there, and I can, with my Microsoft Copilot, say, give me the P&Ls over the last 5 years for these different divisions. Who's made the most money? Where have we wasted money? And you get it back in a second. Bye-bye, assistant manager. You don't need them. And that's going to change, but we're front loading all that change right now in these valuations, in my humble opinion.
Right, and I think particularly with the software stocks, like they're the most vulnerable, and we've seen them disappoint quarter after quarter, is that it is proving to be much more difficult to actually come up with software to use these chips. And so you've got to really pick your point in where we are, and it's really about the infrastructure of the AI, so the actual chips, the energy, where, ultimately the servers. Dell's another big winner that's part of that story, and it'll slowly flow down the line, and when it finally comes to making airlines more profitable or accounting firms more profitable, that'll be a whole nother shift, but we've got to look at that pace. I think the one good thing, to your point, Todd, is that the AI story is getting Gen Zers more interested.
Good point.
And so though, part of it is definitely FOMO and missing out on the investments, I think it really is the story that is getting them more interested. And so if that's what it takes to help them build their portfolios and get interested in investing, perhaps, listening to some advice, not just, doing their own little individual stock picks, that's great. It's all like I encourage anybody, if that's what it gets them to become more interested, that's wonderful.
Yeah, you got that right. And it's obvious that Gen Zers are getting that advice from watching Buy, Hold, Sell. So that's what we love, and that's why we're here for them as well. But listen, let's close out the block on this one, guys, because coming up next, we're going to ask Erin, we got to ask about the political season. Does she take any of that information as far as what we see happening in November? Does she equate that back into the markets? But we'll get.
I want to see what sectors and stocks she's buying, damn it.
And sectors, that's right. Toby's always the one with the T's on the sectors, and we got to talk sectors. We already talked about utilities, and obviously on the tech side with an energy, but we need to break it down a little bit further than that. But we have all the answers with us because we have Erin Gibbs. She is a CIO at Main Street Asset Management, and she'll be right with us right after the break. Please stay with us.
You're making her blush.
All right, we're out.
Buy, hold, sell, brought to you by CrossCheck Management.
Like the Kentucky Derby, Woodford Reserve Bourbon is a spectacle for the senses.
Welcome back to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and of course I'm joined by Tobin Smith. And with us today is Erin Gibbs, the CIO over at Main Street Asset Management. And Erin, when we left off in the last block, we were really touching on the sweet spot of politics, I have to ask you, do you incorporate the political season into your analysis about the stock market?
No, I don't. Just looking historically, I've run a bunch of, ad hoc back test, and whether, the expected winner wins or which party wins, ultimately it flushes out at about 2 weeks. So it's not something that you want to trade because it's so quick, and it's, if you're a longer term investor, it's not something you really want to take into account.
Yeah, and it's these political hacks who are on television to try to ask these questions. Do politics matter to the stock market? That really chaps my spurs, because it doesn't mean squat. I mean, if we elected, I don't know, I wouldn't say that word. If someone really, really strange, maybe that would have problems. But it's the Congress who passes the bills. The president just does the press announcement.
Yeah.
Yeah.
But you know as well as I do, we have had people on the show that have actually talked about that during an election year, the stock market tends to historically is rally, especially when you have an incumbent who is running again. So the markets have done well, and this goes back, I don't know how many election cycles. But the point being is that I know some professionals like Erin will maybe look at that and maybe say that, but I get what you're saying though. 2 weeks after the election, it's a short-lived thing. Why even trade it at all? It's really not worth the risk. But
Erin's
Right, and a lot of those
she went to
studies
NYU, okay, Todd? She went to
Yes.
NYU. So
Yeah, well, a lot of those studies, they're not looking at the 12 months after the election. They're usually
Yeah.
looking at the calendar year. And so most of the returns are actually up until the run. It's more to do with macroeconomics. It's not about what, like, the actual impact that the president has. So it's,
yeah,
like
that's
I
a
said,
brilliant
it
point.
flushes out after 2 weeks. The euphoria is gone and everybody goes back to business.
right.
Yeah.
Also,
Right.
Todd, change sounds good, but the market really doesn't like change. I mean, once you knew what was going on, okay, finally I have these jokers figured out. Now I got to figure out these guys again. So,
Yeah, you're right. You're right about that. So, okay, well, Erin, then you did talk about just in the A block, you were talking about how you're focused on utilities, you like the energy sector. Give us some more sectors that you like. I mean, everybody's traveling. Are you even looking at the travel and leisure index these days?
I think that's actually where we're starting to see the consumer pull back. I would be very cautious on all of the ones that sort of your previous leaders, your travel and leisure, your entertainment, your restaurants. We're seeing people being more choosy, shifting down. We're seeing more hesitancy in consumer spending. I think the inflation finally is getting to people. And so I'm looking more at industrials, B2B, and really more fair valuations, rather than the consumer discretionary. In fact, I would actually say that if you're overweight consumer discretionary, I'd really take some profits in those areas, because we are seeing that inflation is finally starting to wear down. The savings have been spent. We know that people have burned through their excess savings. And certainly, and if the rates continue to be high, I think this is something that everybody should be looking at.
Erin, this is a serious question. When I hear someone say that they're still spending the money they got during the pandemic, do you have any direct proof of that? I mean, like M2 or M1 or anything?
No, that's been spent. Like it's gone.
Yeah.
It's all in fact, we're actually down. I think we're like 40 billion below pre-pandemic savings levels.
Right.
When you look at so like people have not only spent it, they've eaten into some of their savings. Now, look, we still have healthy wages, healthy unemployment. So people are still earning money, but certainly the excess savings is gone.
I think that's the easiest statement to make so far. But I still hear people talk about how, well, the excess savings are still really, when 50% of the population by household, only has 3% of discretionary spending. How is that possible? They're using, but excess, they spend what's in the checking account. They don't put it in a savings account. It's, if you look at where you look where all these checks went, they went into checking accounts. They mostly did not go into savings accounts,
right,
or money market accounts, because they don't have a money market account.
Yeah.
Right. So what about last time you were on Buy, Hold, Sell, you were telling us about the luxury retail sector. Now, I know that when you start talking about the average American consumer, they weren't focused on the luxury retail sector anyway. But are you seeing, I mean, is spending still, I mean, stable in that region, or what do you think? Or are you seeing a slowdown there as well?
There's a slowdown there as well, and we have seen some pressures. When you look at Capri Holdings, the affordable luxury as well as the ultra luxury like LVMH, they are seeing a slowdown. It's a I think it's less of a layup. I think that's one of the stocks actually that we're out of, and then I don't recommend anymore. I think that plays done for now. Particularly that Europe still seems to be struggling. And so while it's still a very popular tourist destination, and I'm sure the Olympics will help some of those luxury retailers with their sales this summer, it's not something I want to take bets on right now, especially with given their valuations.
Well, I call it the Lululemon barometer of how many Lululemons I see being worn at Whole Foods and at TJ's. And it's at Trader Joe's, for those of you who don't have Trader Joe's. And it used to be every female under the age of 75 had Lululemons walking in throughout those stores. And I don't see that at all. Number two, if you look at Lululemon as a barometer for discretionary spending, the stock is probably the worst performing stock in the S&P 1000. And there's a reason for it. I mean, again, there's just X amount of discretionary spending. And how many pairs of Lululemons can you have, Erin? I don't know, but it's like 10. Is 10 enough? I mean, like a new one every day for 2 weeks? I don't know.
Well, they sell men's pants as well there. And I knew that they were.
Oh, I can so see you, Todd, in the Lululemons right now.
Not for me. Not
Thank
for
God
me.
some people here are, listening and not seeing that, because that'd be a rough picture. I'll say the other one though. But Erin, do you follow Abercrombie and Fitch? We've been long them for a year and a half because my niece and nephews tell me how great the clothes are, and they're rich.
Oh, okay. Honestly, that's an unknown that has not popped up for me. So I think it's similar in that one, you've got to think about consumers shifting to cheaper prices, alternative prices, just shifting away from those expensive brand if there is a dupe, a knockoff. But I think another thing is you need to be really cautious about poor management. And so even if you are one of the cheaper companies, let's say like you're a McDonald's, but you haven't been able to get the foot traffic in, you have mismanaged some of your choices. I think those companies are really going to get hit the hardest. So again, looking at your fundamentals, looking at your revenue growth, if you start missing and guiding down, especially in the consumer discretionary space, those are not the companies you want to be in.
You are toast. I did think it was intriguing that since McDonald's basically owns every restaurant and leases it to their franchisees, and they came in and said, oh, by the way, we're starting a $5 meal. And like the president of the franchise association flew to Chicago and said, are you out of your freaking mind? If you looked at it, do you want to just, we hardly paid you any franchise fees in the last quarter. So you want to have less?
Yeah.
That was a little off chord. That was a little off.
Mismanagement.
Mismanagement.
Yeah, no, definitely get that. All right, and one final question for you, Erin. With the here we are, we're just starting summer. I mean, do you see any type of I know it's still maybe a little too early on back to school, but back to school shopping does kick into high gear in a few weeks from now. Is that any part of your forecast as well? Because that used to be a great barometer as far as a proxy. If there's great back to school shopping, that means great Christmas season sales for the retail side.
I know it was for years and years. I know people within the retail industry, it has become less and less important. One, because back to school shopping starts so much earlier.
Right.
So it's not necessarily those 2 weeks that you'll see those retail sales. Another part is it's just, I think ultimately the consumer is going to shift down. I think, it's just going to be part of that overall trend. So even if back to school is a little disappointing, I think that's going to just be across the board for all consumer discretionary stocks. We're going to see a lot of things that are a little disappointing.
Well, yeah, Todd, if you actually look at the 52-week highs, I'll cut that out and send it to you by carrier pigeon. you'll see that Walmart is 52-week highs every week. BJ's Wholesale, 52-week high.
Yeah.
Costco, 52-week high. I mean, it's clearly, and your favorite stock, Target, Todd, is actually, it's not his favorite, Erin, but it, it's actually showing some signs of life.
I love beating up Target. Their earnings report was abysmal, and they're trying to spin it. And now if you remember last year during the Pride Month was when they got into a lot of trouble, and with some of the products that we're offering. As I understand it, Target in their earnings, in their analyst call, they actually said that they're staying away from it. They're not even going to be touching that subject. So I guess you go into the stores, you won't even know it's Pride Month. But who knows if that will bring their loyal customers back, and it just remains to be seen. But we'll see. But listen, we're going to leave it there, guys. So what a wonderful show, Erin. We love having you on Buy, Hold, Sell. We can't wait to have you back. And we just wish you a terrific summer in the meantime.
Thank you.
How about me, Todd?
Toby, come on, you're my favorite. And we talk all the time anyway. So we just have to go on vacation together. But listen.
Hey, you got me on lacrosse, for crying out loud. I was about ready to fly out to the championship. What a scientific ass kicking that Notre Dame gave Maryland, your alma mater. Oh my gosh.
I know. It was brutal. I was very excited. We went up 2-0, but we just didn't finish it out. But Notre Dame's a hell of a team. And those Kavanaugh brothers, they definitely
Kavanaugh brothers.
Again. Yeah, they're something else. So
when you start doing the show on lacrosse, bring me in as someone who doesn't know jack crap about lacrosse and has become a lacrosse fan. I just can't believe those guys swing the bats at each other, and they're hitting each other in the head and the face and the arms and everything, and they don't even flinch. I would not be, dude, with this size head, it's not good to be playing lacrosse, I'm telling you.
Yeah, it's tough. Well, maybe next year when my son starts playing in college, I'll bring you out for a game. But we'll talk then. But listen, we're going to leave it there. So catch this show, Buy, Hold, Sell, and all our other shows on BTT, or you can catch us on Stir, on Dingo, Avo, Tubi, Pluto. Just look us up and we'll be there. And of course, you can hear us through the Evergreen Podcast Network as well. So we want to thank Erin Gibbs, and on behalf of Tobin Smith, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care.
Buy, Hold, Sell, brought to you by CrossCheck Management.
If you like Buy, Hold, Sell Live, be sure to smash the like button.